on to yet another Dhan Ki Baat Arpit ke saath. So friends, you know what happened yesterday. The interest rate hike happened by the Reserve Bank of India, and this time it was 0.5% or 50 bps. So this is a bigger rate hike than the last one, which was 40 bps. So overall in the last 6 months, 90 bps or 0.9% is the rate hike that has happened. अब इसका क्या मतलब होता है? Let's start talking about that. And most importantly, how is this going to affect your portfolio? Because rate hike कहीं पे भी जा रहा हो, what we need to know or what we care about is कि how is it going to affect our portfolio, our health, our wealth, or the health of our wealth. So that's what we're going to talk about today. And we'll be talking about different aspects, macroeconomic as well and microeconomic as well, something directly to do with portfolio. Going forward, what should you do? Will the RBI increase rates even further? So I'll be answering all of those questions for you today. So who am I? My name is Arpit Arora. I'm India's leading personal finance expert and passive income coach. And I'm on that quest to, empower, mentally empower the people in the context of finance, which is upgrading your financial IQ. So this is why I do what I do. So that India as a nation, especially the middle class of India, they're able to change the way they think, they feel, how they act with money, and they are able to get better results when it comes to money. For sure, that middle class works hardest in the entire nation. They're the backbone of the nation. But they are the ones who struggle the most with money despite working so hard. That's something I want to change. By the time I'm done, I want to make that change in India. So with that vision in mind, I do these weekly live sessions where I keep on talking about what's most important to people, where can they go wrong, what mistakes can they do, and what should they do instead. So coming to today's session, why today is all about the effect of RBI's interest rate hike on your portfolio. So we'll be talking about that. So we know currently almost 1% hike has already happened. But the interesting thing is ki, what RBI is doing is that they are enabling the infrastructure sector to grow, parallelly increasing the interest rates. So first, let's start with why are they increasing the interest rates? They're increasing the interest rates because inflation is going up. So if you have been, if you've been following my videos, if you've been following what I say since the last 2 years, you would note I did mention that if the RBI increases their, if the government spreads money like 12-13 lakh crores, how they spent, and they gave it to different sectors just to take the economy out of the COVID situation that we were in, it will also have negative effects. Yes, it was required at that time, but it will also have negative effects. This is the negative effect we're talking about, because inflation came back big time. So when more money gets circulated, price of assets go up because there is more demand, and that demand is because there is more liquidity, and that liquidity was created by the finance ministry. So, and on top of it, war also happened, so it made situations which were supposed to be bad, it made them really worse. So while RBI had been reducing the rate of interest since 2014 till 20, which they did in 2020, now it is coming back to normal, or rather there is no such thing as normal, it is coming back up again. So as the interest rates go up, it is going to have certain effects on your portfolio. What are the effects going to be? One, people who invest into debt, people who invest into long-term debt, if they have invested into especially debt mutual funds, which are not short-term or not liquid, those portfolios are likely going to give a markdown or lower return. Because what happens is, if the interest rate goes up, the price of the bonds come down. So the bonds that you would have bought, which are not expiring in maybe 1, 2, 3 years from now, maybe longer, those bonds are going to get affected. Especially those mutual fund returns are going to go down. So that's one negative effect. For people who have not yet invested into the debt market, they will now get better rate of interest. So it's a positive for those set of people. If you haven't yet invested in debt, and I know that a lot of people don't, then so I know a lot of people don't, then in that case, um, the whole idea is that um, we should not really, we should focus on investing into debt. We should focus on investing into an asset class which is able to give you a fixed rate of return. That's extremely important. Now, if I talk about other aspects, what other aspects that does the rate cut come with? One, it comes with a good banks, and banks tend to gain the most when rate hikes, because the banks get a chance to lend at a higher rate first and then slowly increase the rate of interest. So the first people who benefit from these kind of scenarios are the banks. So the banks, that sector, the banking sector, is poised to do well. So people who are looking to invest in stock markets, this is one sector which can do well. But if you look at overall stock markets right now, it's under tremendous amount of pressure from the foreign portfolio investors, because for the last, I think, more than 6 consecutive months now, they've just been selling and selling. So foreign portfolio investors or foreign institutional investors, known as FIIs and FPIs, both have been negative on the Indian market. They're taking out their profits. So that is putting a lot of pressure on the Indian markets, especially stocks have been battered. Like the stock market might be 15% down, but if you look at individual stocks, they are battered 30%, 40%. Some stocks are down 50% as well. Only few select companies have been able to hold their prices. Most of the other companies have taken a big hit. So in a time like this, one should be very cautious of investing. Focus should be towards investing into short-term debt only. If you have already invested into indexes or stocks or mutual funds, just keep your investments intact. Don't sell them. Don't add more. Wait for further correction to buy more, or stay put. What you invested, just stay on with that. As long as you have good quality investments, obviously. It doesn't mean if you bought a penny stock and then you follow this advice, it won't work. So the overall picture you need to understand is we are moving towards, and there is further increment in interest rates still possible. So the things one should surely I advise is, do not invest into long-term debt for sure, especially mutual funds which are long-term in horizon. They are likely going to give you a very poor return. Medium-term debt is okay depending on what you invest in. Short-term debt is great to invest in right now, because you will get a high of that. Being cautious with equity is most important, because equity market for money from FIIs, but that's not coming, and retail investors are just ensuring it doesn't fall even further. So it's kind of in a very tight range. So it's hard to say where it's going to go, but being cautious is the approach that I'm taking right now. If it falls further, I would invest more. If it doesn't fall, I will not invest anymore. If it goes up from here, nothing like it. So overall, I would like for you to understand is, and this is very important, macroeconomic factors will keep on changing, microeconomic factors will keep on changing. If you do not align your portfolio and your wealth along with these different factors, then some or the other time one trigger will give you a big shock. Like people who recently invested into bonds for, let's say, safe returns, and they assume that they will never go in negative. Many bonds either have defaulted, like SREI, even Future Group. Their bonds are defaulting as we speak, and this is like right now. And other people who invested into the overvalued stocks, they are again making big losses. So if you don't understand the game of finance is very, very important that you first learn it and you take guidance or advice from people who know how to win the game. That's very important, because I made a video on this not so long ago about taking free advice. People are all about ki I get a free advice and I'll do my own analysis. This approach doesn't work because we don't know enough about it. So if I have to travel to another country, even if I get a plane, I won't fly it myself, because I might know how to fly it, but I very likely can crash it as well. So that's the last thing you would want to do with your money too. So I hope you've got a new perspective. I hope some of the tips that I gave you would be helpful for you. I do live session. If you have any questions on what I've asked you, what I've shared today, or if you have any personal circumstances, any questions to ask, just hit me in the comments and let me know. I personally will look into them and answer it. And if you have any topic for me to share in the next, invest wisely.